Hello again, Michael Solomon here, giving my thoughts on the ransomware hack of last weekend from a risk management point of view. Ransomware is currently the method of choice for cybercriminals. If they steal credit card numbers, for instance, they still have to monetize that, which is extra work and with perhaps an increased chance of getting caught. With ransomware, they don't need to sell anything, just hijack a computer and set up a Bitcoin account. The opening that allowed the ransomware was a failure to update patches to Microsoft products. Microsoft had previously identified a potential security flaw in their product and had released a patch that fixed it. My paper discusses the importance of patch updates. A patch is a free update to a program you already own. Software vendors, such as Microsoft, release patches for a variety of reasons. One of those reasons is to close loopholes that allow hackers in. As hackers find loopholes in code to exploit, vendors close them and release the more secure code as a patch. Patches are fairly frequent and will often have no discernible effect on the user experience. So what accountability will there be for this hack? My opinion was, as expressed in my paper, and remains, that insurance companies can, in the insurance contracts, establish a minimum level of cybersecurity as a condition of insuring their clients, and that patch updates should be a part of that minimum level. My company is 5 people, and we have regular patch updates. Companies today typically have all computers linked up to a centralized network for troubleshooting purposes, if nothing else. This network should be used to send out updates on a regular basis, not less than weekly, in my opinion. I work a lot of hours, but I can tell IT which 2 hours in a week I'm not going to use my computer, e.g. Saturday from 2 a.m. to 4 a.m. Insurance fails when the insured does not have skin in the game or any incentive to take risk control measures. Some experts have already expressed concern that some businesses use cyber insurance as a replacement for sometimes expensive technical cyber risk management, rather than protection in case their cyber risk management fails. This is called moral hazard in insurance literature. Basically, insurance works by pooling risk, thereby reducing the risk of extreme outcomes to one insured. A risk with 100% likelihood cannot be insured. That's just pre-planned expenditure. Insurance companies exist to make a profit and will stop writing cyber business at all with such loss ratios. One social advantage of insurance is that it can give financial incentives and penalties through discounted or increased premiums to improve social behavior. For example, I went to a driver's ed class voluntarily to reduce my premiums. Our house has an alarm system, and the home insurance discount helps defray some of the cost. My wife wants to get an AED in our home, they cost around $1,000, and I'm going to ask my life insurance company if they will give a discount. If they do, I'm more likely to buy one. If there is a greater discount for having one on each floor, I'm more likely to buy 2. If insurance companies continue to cover claims caused by failure to reach minimum security standards, there is no incentive to ever reach those standards, and the door will remain open for cyber criminals. Cyber insurance premiums will increase for all companies to cover those losses, eventually becoming unaffordable. For conscientious companies who invest in cybersecurity, premiums will skyrocket far beyond any benefits, killing the market. For any older economists out there, like myself, this in my mind is akin to George Akerlof's Market for Lemons paper, a classic from 1970. Therefore, as I wrote in my original paper, which is also on my LinkedIn profile, insurance companies need to place minimum standards in their contracts and enforce them through denying claims. I'm presenting at KMOM on Thursday, and I hope to see anyone from the Pennsylvania, New Jersey, or Delaware Triangle there. Thank you very much.